Welcome to Acera's new employee / mid-career seminar. In this seminar, we're assuming that you're either new or you're somewhere in your mid-career, hence the name. So you're not near retirement yet, which is a good thing because that means you still have plenty of time to plan for your retirement. So in this seminar, I'm going to tell you all the things that you might want to know about doing that planning. And since you're curious enough about retirement planning to watch this, you probably have some questions. Questions like, what do I need to know about my pension? And what do I need to do? Do I need to do anything? And if so, what do I need to do? So we're going to answer those questions during this presentation. I have your answers to the questions. I have arranged the presentation in the form of a checklist. So here's everything that we're going to cover during the presentation. I'm going to help you understand retirement basics. We're going to talk a little bit about pension math. So this is how we calculate your retirement benefit that you're earning. And I'll talk about purchasing service credit during that time. I'll help you get a pension estimate. I will help you understand retirement eligibility. So this is the point in the future when you become eligible to retire, if you're not already eligible. I'll help you understand a few additional benefits that we offer. I'll help you designate your beneficiary or beneficiaries and understand career planning options, and I will help you make a retirement planning picture. We'll also talk about you starting a 457B account if you haven't done so yet, and just a little bit about signing up for Acera News. Okay, let's jump right in. Like I said, if you have questions as we go along, feel free to type those into the Q&A. Okay, first off, understanding retirement basics. Let me just make a few adjustments here. Okay, understanding retirement basics. So who is Acera? In one sense, Acera is this acronym, the Alameda County Employees Retirement Association. So that's just our name. But Acera is made up of a lot of people. So there are about 90 of us that work here, and what we do is we provide retirement, disability, and death benefits to our members of Acera. That's you. You are members of Acera. And you are a member of Acera because of the position that you work in. You work full-time in a retirement eligible position, and who you work for. You work for one of the public employers that participates in Acera. These 6 employers use Acera as the pension system so that their employees can earn a strong retirement. And because you work in this position for one of these employers, you're automatically an Acera member. And as an Acera member, you contribute to Acera's fund. So with every paycheck that you make, part of your paycheck comes out of your check and goes into Acera's fund every single time. You can actually look at that on your pay stub and see that in the pre-tax deductions column. Now, your employer is also contributing to the fund on your behalf. So we have what you're contributing, we have what your employer is contributing, and so what do we do with that money? Well, we don't want it to just sit there, so we invest it all over the world in a lot of different types of broad investments with the goal of earning interest on that money. So these 3 sources of income, what you're contributing, what your employer is contributing, and the interest that we earn give us this big pool of money we call Acera's fund. So what do we do with that money? Oh, and this is just an example of you being able to see your retirement contributions coming out of your paycheck. So what do we do with this Acera's fund? Well, meanwhile, you are earning credit toward retirement while you're working. So here is an illustration of you working hard at a computer, and then, or whatever job that you do. So you're earning credit toward retirement, and then at some point in the future, you are going to retire, and you're going to start collecting that retirement that you earn. So here's the good news about that. Once you retire, you're going to collect that benefit that you earned, what we call your monthly retirement allowance. You're going to get that for the rest of your life. You cannot outlive your retirement. So as you're working, you're earning a certain retirement based on different factors that happen as you work, based on the credit that you earn toward retirement. And based on that credit, then you get to collect a retirement based on what you earned. pensions are really special. So everything that you contributed to the retirement system throughout your entire career, once you start collecting that monthly retirement allowance, you're going to get all of your contributions back paid out to you through that retirement allowance within your first 3 to 5 years of retirement. Everything after that is just almost like a bonus for you. And it's the employer contributions and mostly the interest that we earn by investing your money that allows us to pay that lifetime retirement allowance. So if you're retired another 30 years after that first 3 to 5 years, then before you pass away, then that extra 30 years is just like a bonus. And it's a bonus based on the power of pensions. So it's an amazing thing that you're able to participate in this, and what it does is it allows you to predict what your retirement situation is going to look like. It allows you to plan for retirement, be confident of what you're going to earn in retirement, and then go ahead and retire and collect that retirement for the rest of your life. So let me show you some pension milestones. We have the first milestone in the chart. We have your date of hire. So this is your first day of work in your full-time retirement eligible position. Now, if you got hired into that position, this would be the day that they first told you to show up to work. If you started out in some other capacity, like maybe you started out working part-time or under contract or seasonally or something like that, this date of hire would be the day, your first day in that full-time retirement eligible position. Okay, so then for the vast majority of our members, what happens is your second milestone is the first day of your second pay period, and that is your date of entry into ACERA. So that's the first day that you're an ACERA member, that's the first day you start owing contributions to the retirement fund, and that's the first day you start earning credit toward retirement. Now there are a couple of employers where your date of entry into ACERA is actually the same as the date of hire, and if I recall correctly off the top of my head, it might be the Alameda County Housing Authority. But if you go to our pension timeline page on our website, it will tell you who falls into that category. Okay, so once you're an ACERA member, what happens is 5 years goes by. After 5 years, you're considered vested in the retirement system. And vested just means guaranteed. So once you have 5 years, you're vested in the retirement system, you're guaranteed the vested benefits. You're basically guaranteed the guaranteed benefits. Okay, so when you hear people talk about vested benefits, that's just the guaranteed benefits that are guaranteed by state law. And once you reach that 5-year mark, then you're guaranteed those as soon as you're eligible to retire. Okay, so that actually is the next milestone in the chart, which is retirement eligibility. So that comes at some point after you're vested, and it's based on a particular scenario, and it's usually has to do with how many years you've worked and how old you are. So there's like minimum cutoffs that allow you to be retirement eligible, and I'll talk about what those are exactly during the presentation. But once you meet those minimum requirements, then you're eligible to retire. Okay, so you can retire on that day, or what most people do is they keep earning a retirement. So at some point in the future, there is a day where you go to retire, and this is a date that you choose. So you plan your retirement out, you choose your retirement date, and you retire. Now there are a couple more milestones on here. One is your death, and the reason it's on here is because you are collecting your retirement allowance starting on the day you retire and all the way up until the day that you die. So your retirement is going to be paid all the way for the rest of your entire life. And then there's another milestone on here, which is that at the time of your retirement, there are various retirement options that you can choose, and some of those allow you to leave a continuing payment to a beneficiary after your death. So after you die, then your beneficiary can continue to receive monthly payments until they pass away. And so that's why that is on here. So those are the pension milestones. Just really quickly about vesting. Like I said, it happens when you earn 5 years of service credit. So after you've worked here full-time for 5 years, you earn 5 years of service credit, you're vested in the retirement system, and it's guaranteed by state law. And the vested benefits are the the retirement allowance that you will get for the rest of your life once you retire, an annual cost of living increase to that retirement allowance, and a $1,000 lump sum death benefit. Now, like I said just a minute ago, there are other death benefits that are connected to the retirement allowance as well. Okay. So I have a question. Who can the beneficiary be after you die? Can it be that can the children be the beneficiary, or does it only apply to the spouse? So if you're married or you have a state-registered domestic partner who you have married or registered with the state at least 1 year prior to your retirement, for the basic option, which is called the unmodified option, that your spouse or your state law kind of requires that your spouse or domestic partner would have to be your continuous beneficiary, unless they sign away that right, and then you could name minor children. There are other provisions for you having the ability to name adult children. I don't take a deep dive into the different retirement options in the new employee / mid-career seminar, which is this one. But if you want to watch one of our pre-retirement seminar videos, I do take a deep dive into that kind of toward maybe like 3/4 of the way through that seminar. You can also check out our death benefits page, which talks more about that at acera.org/death. Okay, regarding pension basics, you are all in a tier, one of Acera's tiers, and it's based on your date of entry into Acera. So it's that second milestone on the pension milestones chart, your first day of Acera membership. And the tier that you go into depends on when you entered Acera and whether it was before or after one of these cutoff dates that gets you into one of the tiers. Okay, so to find which row you're going to look at here, which timeline, first of all, safety members are like sheriff's deputies, probation officers, and other sworn officers. And so if you're not a safety member, you're a general member. So that's these three up here. So if you're just a general member, you would be looking at this one. Now for Alameda County Housing Authority and Livermore Area Recreation and Parks District, you have a separate timeline that has a little bit different dates. You're still a general member, but you would look at this timeline. Okay, so now that you know which timeline you're looking at, the way it works is, if you're a general member and your date of entry into Acera, your first day of Acera membership, is before July 1st, 1983, that puts you in Tier 1. Since this is a new employee / mid-career seminar, I'm assuming there's probably no Tier 1 people in here because that was long ago. Now, if you entered Acera July 1st, 1983, all the way up to December 31st, 2012, that would put you in Tier 2. And if you entered Acera January 1st, 2013, and beyond, that would put you in Tier 4, and that is true of all of the different timelines here. Now for safety members, let me point out something. If you entered Acera October 17th, 2010, all the way up to December 31st, 2012, you were put into Tier 2C or Tier 2D based on a selection that you made within 45 days of achieving your safety membership. And if you didn't make a selection, you were defaulted into the lower tier, whichever one that was. I think it might be Tier 2C. So that's that. And then for Livermore Area Recreation and Parks District and Housing Authority, you have these other date cutoffs that you can check out to figure out your tier. So that's how you know what tier you're in. If you don't know what your date of entry is and it's around one of these dates and you want to know for sure, what you can do is you can log into your account on our website and it will tell you in there exactly what your date of entry is. And it will tell you exactly what your tier is as well. So you don't have to come back to the chart to figure it out. Okay. So since this is a new employee / mid-career seminar and we're going to talk about retirement planning, I wanted to show you this slide right now to kind of orient you to some of the topics that we're going to talk about, kind of like the big picture. So when you go to retire, you're going to need income to live on. And that income is going to come from various sources. One of those sources, since you're earning a retirement at Acera, is going to be your Acera monthly pension, which is the monthly retirement allowance that we're talking about. Also, if you are paying into the Social Security system, and that's everybody except for safety members, and I think even if you're a safety member and you paid in for at least 10 years full time, then at some point in the future, you will become eligible to collect Social Security, and that will be another source of income. And anything beyond that is your personal savings and investments. And what financial planners will say is that in order to maintain your standard of living that you enjoyed before retirement, in retirement, your income is going to need to be 70 to 80% of your salary that you were making before you retired. So that can feel nerve-wracking to people at this point. That feels nerve-wracking to me when I say it. So I get that. So what I'm going to do is give you a bunch of information during the seminar about how we're going to get you pointed in this 70 to 80% trajectory so that you don't have to worry about this. So we'll get you pointed in that direction, and it'll bring your nervousness down like 5 notches. Okay. We're going to talk about, the reason I'm showing this to you now is to give you kind of a broad overview, like kind of a high-level picture. We're going to talk about the ACERA monthly pension, and then we'll dive into retirement planning and talk about these 2 other parts of the equation. So we'll return to this slide in the future. Okay, the next item on our checklist for the webinar is understanding pension math. The reason I'm going to tell you about this is this helps you plan for retirement. If you understand how we are calculating your retirement allowance, and that also means if you understand how you're earning your retirement allowance and at what rate you're earning it, then you're going to be able to plan for the future more effectively. So I'll keep it as high level as possible, and it's actually not super complicated. It's a pretty basic equation. So it's this multiplication here. So when you go to retire, we are going to do this calculation for you. And what happens is, in retirement, you are going to get a percentage of your highest salary for each year of service that you earn. Basically, each year that you work. Okay, so you're going to get a percent of your highest salary that you earn, so your highest salary at any point in your career, for each year of service that you work. Let me give you an example, and it will help illustrate this idea a little bit better. This equation is kind of like the math version of this statement. Okay, so let's say that the percent, just to give you an example, the percent of your highest salary that you're going to get for each year of service, as noted by this H factor percentage factor in the formula, let's say it's going to be 2%, okay? And let's say that you work full-time for 20 years, which means you earn 20 years of service credit with ACERA. Okay, so in retirement, that means that you're going to get 2% of your highest average monthly salary from any that you earned during your career. You're going to get 2% of that salary for each one of these 20 years of service that you worked before you retired. So if you're getting 2% of your salary for each one of the 20 years, that means you're getting 40% of your highest average monthly salary in retirement. Now let's say that your salary while you were working was $5,000 a month. Well, 40% of $5,000 per month is $2,000 per month. So that means that you achieved 40% income replacement just from your ACERA pension alone. Okay. Now, the higher any of these factors are in the formula, so the older you are, the older you are when you retire gives you a higher age factor percentage. The more service credit that you earn, so the longer you work here, you earn more years of service, or the higher salary that you earn, because this is a multiplication, the higher any of these 3 numbers are, that makes your monthly retirement allowance go up. Okay, so to earn more and more retirement allowance, you simply get older, you work here longer, And you get like raises and cost of living adjustments you earn, and promotions you earn higher and higher salary. Okay, and that gives you a higher retirement allowance. Okay, so I give you an example that is just kind of a general example, but what percentage of your highest salary will you get for each year of service, to be specific? Well, it's going to depend on your age at retirement. So this is a sample age factor percentage chart that tells us what age factor percentage to use in the formula for you. So this tells us what percent of your salary you're going to get for each year of service credit. And the way you use this chart is, first of all, you find which column you should be looking at, and it's based on your tier. So if you're a safety member, you're looking at this half and you find your tier over here. If you're a general member, you look at this half and you find your tier here, and once you find your tier, you forget about all the other columns. You're just looking at that one column. So let's take the tier 4 general column just as an example. So let's say that you're a tier 4 general member and you work all the way up to age 65 and retire. So what we're going to do at Acera is we're going to come over to this chart. We're going to say tier 4 general. We're going to come down to age 65, 2.30%. That is the number we are going to stick in the retirement formula for you as your age factor percentage. That's the percent of your highest salary that you're going to get for each year of service. So that's how we determine what that percentage is going to be. It's based on your age at retirement. Now you may notice a few things about this chart. One is that the numbers get bigger. So the older you are when you retire, the higher the percentage you're going to get in the formula for you. Now you might also notice that the numbers max out at a certain age. So that is represented by the blue box. That is the maximum age factor percentage that you can get. So for example, for general tier 2 members, if you retired at age 62, you get 2.09%, 65, 2.43%, 67, still 2.43%, because 2.43% is the maximum age factor percentage you can get for your tier. So if you retire older than the maximum age for your tier, you just get whatever the maximum age factor percentage is. And another thing that you might notice is I skipped a bunch of the ages, and actually the percentages increase with each quarter year, and it's based on your birth date. So for example, if your birth date is January 15th, a quarter after your birth date is April 15th, 2 quarters after is July 15th, 3 quarters is October 15th, and so on and so forth. So every time you pass one of those dates and you don't retire, you go up one notch in this chart and you get a slightly higher age factor percentage in the formula for you. And you can see all of the age factor percentages on our website if you like math and you like to see how that works. Okay, so that's a lot of information I just threw out at you. If you forget all of that, the main thing that I want to have you remember is that the older you are when you retire, that equals a higher age factor percentage, up to the maximum for your tier. Okay, so that's just kind of the bottom line regarding the age factor percentage. Now let me tell you about service credit and earning service credit. You start earning service credit as soon as you enter Acera. And you're going to earn service credit while you work all the way up until you retire. And you're going to earn it each day, and in fact each quarter hour that you work, you're going to earn service credit. If you stop working before you retire, so some people stop working and defer their retirement to a later date, you would simply stop earning service credit whenever you stop working. We'll take a deep dive into what happens if you stop working before you retire a little bit later in the presentation. But while you work, you earn service credit. So during your regular working hours, you earn service credit. Also, all of these types of earned leave, including your vacation time, sick leave, if you're in management leave, or comp time, holidays, floating holidays, you earn service credit during all of those times. Those don't count against you in terms of service credit. And they don't really count against you for anything. Now, there are some times when you don't earn service credit, and that is anytime you're out on leave without pay, you're not earning service credit. If you purchase additional vacation, which is an ability that most of our employers allow you to do, which is you purchase extra vacation on top of your earned vacation. While you're out on that purchased vacation, you're not earning service credit. Okay, also if you sell vacation, which is selling your earned vacation, so that's different than purchasing more vacation. This is like selling some of your earned vacation so that you have less vacation, but you get some cash for it. You don't earn service credit for sold vacation. You also don't earn service credit for overtime, on-call time, and standby time. Okay, now let me just talk briefly about purchasing service credit. So remember when I showed you the formula, and remember when I told you that the more of any of those three factors you have, basically the older you are, the more service credit you have, the higher your salary. That means a bit larger retirement allowance because it's a multiplication. Well, what that means is that if there are types of there's this list of types of time that are eligible for you to purchase, and that will increase your amount of service credit. So that will increase the service credit that we calculate in the formula for you, and it will increase your retirement allowance. So if you have one of these types of time hanging out there, and it's basically time that all the categories are kind of like times when you could have earned service credit if the circumstances were slightly different, but because the circumstances were what they were, you didn't earn service credit. That's basically how I would summarize what these types of time are. And then so that type of time becomes purchasable. So if you have one of these types of time, my recommendation is to think about purchasing it. So the first type is what we call ineligible or non-covered service. And that is like if you started out part-time, and we're not talking about working for a temporary agency or like working under contract, you were just plain old part-time working for your employer. You didn't become an ACERA member yet until you got your full-time job. And so you weren't earning service credit for that part-time work. But then once now that you're an ACERA member, that part-time work becomes purchasable. Also, the county's temporary assignment pool, which is what TAP stands for, all of that time is purchasable. Or if prior to your ACERA membership you did any seasonal, intermittent, service as needed project, per diem work, or per diem work for your employer, that's purchasable once you become an ACERA member. Okay, now there's these days between your hire date and your entry date. That's those 2 weeks. That's purchasable. If you go out on unpaid medical leave during your ACERA membership, when you return from that leave, that's purchasable, and it's unpaid medical leave based on your own medical conditions, not a family member's medical conditions. If you go out on state disability insurance leave during your membership, when you return from that leave, it's purchasable. If you go on military leave during your membership, during your active membership, when you return from that leave, that's purchasable. And then these two right here, if you used to be an ACERA member in the past, so this is regarding prior memberships, you used to be a member, okay, and then whenever you quit your job, you did what we call, you took a refund of your retirement contributions. But then you got another job that's ACERA covered, and now you want to put that money back so that you can get your service credit back that you had originally earned from the prior membership. You can do that. That's called a redeposit. There's also this one here, which is redeposit of community property. And what that is if you're married or you're in a state registered domestic partnership, since California is a community property state, if you earn retirement while you're in that marriage or state registered domestic partnership, that's considered community property up for division if you get divorced or you dissolve that domestic partnership. And so whenever you negotiated the divorce or the domestic partnership dissolution, some of your service credit and contributions got negotiated away and your ex-spouse got them. If your ex-spouse decides to take a refund of their part that got divided off, at that point we'll send you a letter and telling you that happened, and you have the opportunity to like pay that same amount of money back into ACERA and get your service credit back. That's called a redeposit of community property. And then finally, if you used to be, this one right here, other California prior public service, if you used to work for another agency in California that is not covered by ACERA, but is covered by a different pension fund, and that can include other counties in California, the state of California, or other employers that use the state's pension fund, which is CalPERS, Another example is East Bay Mud, the Port of Oakland, Alameda County Cities or Schools. If you are not eligible to collect a pension from their pension system, either because you didn't work there for long enough to be eligible or because you took a refund from their pension system, you can buy that time as a SARA service credit. Okay, so those are all the categories that are eligible for purchase. Now there's, I always get questions about these different types of time. These are not eligible for purchase. So if you purchase extra vacation time, which we were talking about a minute ago, and you go out on that extra vacation purchase time, while you're out on that purchase vacation, you don't earn service credit and it's not purchasable later. The good news is that you got to go to the beach for a week or whatever you decided to do, but you don't get service credit for that time. Also, any leave without pay that's not medically related, that's not purchasable. Contract time or temporary agency time is not purchasable. And those other prior public service, this category, if you still have your contributions on deposit with their pension system, you can't make the service credit purchase for this category until you take a refund from their pension system. Okay, now how much does purchasing service credit cost? If you do have one of these types of time, either now or in the future. Well, it's going to cost whatever your employee contributions would have been had you worked that time. So let's say that you went out on 3 months of unpaid medical leave, and you come back from that unpaid medical leave. Had you been working for that 3 months, you would have been contributing to the retirement system at a certain rate based on your situation and a certain amount based on your salary. So whatever those contributions would have been, that's what you have to pay to a SARA in order to purchase that 3 months worth of time in this example. Plus, you have to pay the interest that money would have earned between then and now. So if you come back from that 3 months and you purchase it immediately, maybe we haven't passed one of our interest earning periods and you don't owe any interest. But we post interest twice a year, so every time you pass one of those interest posting dates, the purchase cost gets more expensive. Because had that money been here with a SARA's fund, we would have invested it and it would have earned interest. So you have to pay for that interest in addition to the contributions in order to make the purchase. So that means that the longer you wait to purchase service credit, the more expensive it gets. Another way to say that is the best time to purchase service credit is as soon as you think of it and as soon as you are able. In order to make a service credit purchase request, you simply fill out our service credit purchase redeposit request form. You can find that and this is a link to your personal account at ACERA. You can also just go to acera.org and press the account login button, and there's a purchase request form in there. Once you submit that request, what we're going to do is calculate the cost of the service credit purchase, and we'll send you a letter telling you how much it's going to cost. And at that point, you can decide if you want to make the service credit purchase and how much of the purchase you want to make. And going back to the list, the how much part of it, like if you only want to purchase a portion of it, that counts for all of the types of time except for the redeposits. The redeposits are all or none. Okay. And then regarding cost, one more thing I want to mention is that for all of these ones that count toward vesting, that's all the ones that are not the other prior public service. What the contributions that you have to pay to make the purchase is the employee contributions only. If you're trying to purchase time from one of the other public agencies, you're going to have to pay the employee portion of the contributions and the employer portion. So this usually costs triple what the other ones cost. So just to let you know, it could come back as pretty expensive. And then you have these different payment options that you can for you to actually make the purchase. So you can write us a lump sum check on a post-tax basis. You can roll over pre-tax funds from one of these types of retirement accounts if you have one. We could do payroll deductions post-tax, so we can split it up over time, or we can do any combination of these. And then I usually get the question, is purchasing service credit worth it? Like, how do I figure that out? Because you get this letter in the mail saying it's going to cost whatever, $2,000. And you're like, well, that's kind of a chunk of change. Do I want to do this? Is it really going to affect my benefit that much, my retirement allowance? And so here's how you figure that out for yourself. You log into your personal account. So here's the link. WMS stands for Web Member Services, or you can just log in on our website. And in your account, you're going to find something that we call the benefit estimator, and it'll say estimate a benefit. And so you click on that screen and you use that benefit estimate calculator. And you're going to do two estimates. For both estimates, you're going to do the same retirement scenario, which is you're going to choose the same retirement date for both of these estimates. Okay, so you're thinking in the future, if I retire in 20 years, I'm going to do these two estimates, so you use the same date from 20 years. Just pick a date. And then in that estimator, you're going to see a service credit override field where you can override the amount of service credit that the estimator uses to calculate your retirement. You leave that blank for estimate 1, so you do not override it. That's going to give you a certain estimate. Okay, for estimate 2, you're using the same retirement date, but you're going to override the amount of service credit that the estimator is giving you for your scenario. So you're going to take what it tells you you will have earned in the scenario, and you're going to add to it how much you're trying to purchase. So if you're going to retire, let's say you're going to retire 10 years from now, and you will have earned 15 years of service credit by then without overriding it, and you're trying to purchase another 6 months of time, that's half a year, so that's 0.5. So you would take that 15 it's giving you, and you would add the 0.5 to it, and so you would put 15.5 in the service credit override field. And then you click submit for that estimate. It's going to give you a second estimate PDF, and your retirement allowance is going to be higher in the second estimate because you have more service credit. So then what you do is you just look at the difference between your retirement allowance estimate between those two estimates, and you just subtract estimate 1 from estimate 2 to find out how much bigger estimate 2 is. Okay, so this is how much more money you would make per month in retirement for the rest of your life if you made the service credit purchase. And then if you want to figure out how long it's going to take to get that money back in retirement, what you can do is you can take the purchase cost that we told you in the letter that we sent you, and in the example I gave you, we sent you a letter saying it's going to cost $2,000 to make the service credit purchase. So you take that money and you divide it by this number, by the increase in your retirement allowance. And that will tell you how many months in retirement it'll take to get that money back that you paid. So if we tell you a service credit purchase is going to cost $2,000 and it's going to increase your retirement allowance by $100, that's only going to take you 20 months in retirement to get that money back. That's less than 2 years. So that sounds pretty worth it to me because you're going to get that higher retirement allowance every month for the rest of your life. Now, if when you do this division and it tells you it's going to take way longer to get your money back, maybe it's like 10 years to get your money back or 20 years, then you kind of go, I don't know if it's worth it necessarily to make that service credit purchase. So that's how you decide for you whether it's, you figure out how long it takes you to get the money back, I think is a good way to do it. Okay, so that is everything that I want to tell you about service credit at this point. So we talked about the H-factor percentage of the retirement formula. We talked about the service credit portion of the retirement formula. Let's talk about the final factor in the retirement formula, which is the highest average monthly salary. So in order to calculate this, what we do at ACERA, what the law tells us that the way we have to calculate it, is that we have to determine from your payroll records, we have to determine what we call a final compensation period, which is your period of highest pay from your entire career. For tiers 1 and 3, your final compensation period is your highest consecutive 26 biweekly or 12 monthly pay periods, depending on how you're paid. For tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. So essentially, for tiers 1 and 3, it's your highest year of pay, and for tiers 2 and 4, it's your highest 3 years of pay. Okay, and this is your highest period, your highest consecutive period of pay anywhere in your entire career. For a lot of people, it's the last year or 3 years, but sometimes people will take a different job at the end of their career, and then it could be some other period earlier in your career. So we're looking for your absolute period of highest pay in your career, and then what we do is we look at your average pay during that highest period. And so for tiers 1 and 3, we divide it by the 12 months in that period to figure out how much you made on average per month during that period of highest pay. And for tiers 2 and 4, we divide it by 36 months, and that also gives us the average. And so this is the number that we put in the retirement formula for you, your highest average monthly salary. And the types of pay that are included in that salary are, of course, your base pay. And for all of these types, it's gross pay. So it's before any deductions are taken out. So it's your base pay. And then there may be some other pay codes that are included in there that are considered pensionable. But I can't tell you whether one of your pay codes, sometimes known as footnotes, are going to be in or out of this equation. Off the top of my head, because there's like 1,000 different pay codes. But you can check our pay codes page on our website and pull up the list for your employer, and it will tell you, it will say yes or no whether your pay code that you're receiving is in or out of this this salary calculation. But overtime, again, never counts. And then for tiers 1 and 2, if you get paid for vacation during that final compensation period, vacation that you earned and are not going to take, either through selling vacation or simply having it on the books when you stop working, cashing it out, if that pay comes during that final compensation period, then that will be included up to a certain limit. It will be included in your salary for the purposes of calculating your retirement. But that doesn't, we don't do that for tier 4 because the law that created tier 4 prevents that. And for tier 3, you are not able to sell vacation while you're still employed, and that prevents us from being able to do it for you as well. Okay, so one more thing about salary is that for tier 4 members, since this is a new employee / mid-career seminar, so there may be a bunch of tier 4 members here. Tier 4 started when the state did a pension reform law called the Public Employees Pension Reform Act, and that was passed in 2012 and started on January 1st, 2013, which is why Tier 4 across the board starts on January 1st, 2013. So if you entered a SARA that day or after, you are in Tier 4. And another thing that law did is it established a salary cap for what we can consider pensionable salary for the purposes of calculating your retirement. And it's based on the Social Security Wage Index limit. And so just to give you what the numbers are currently for 2021, it's $128,059 for general members and $153,671 for safety members. That means that if during the year, I mean, it's kind of high salaries, but if during the year, the earning year, while you're actively working and earning retirement, once you earn more salary than the cap, then we stop taking retirement contributions from your paycheck until the new year starts over. And then we'll start taking retirement contributions again. And it also means that on an annual basis, we can't include any more salary than this as salary for calculating your highest average monthly salary. Now, since this is a new employee mid-career seminar, I'll say that since your retirement is probably many years away, these caps go up every year. And so it's based on the Social Security Wage Index limit, and so these increase every single year. And so when it comes time for you to retire, what you should do is check our website and see what the limits are at that point. I think I saw a hand go up, but go ahead and type your question into the Q&A. I found that the Q&A is more efficient in answering the questions during these webinars. And our website, the limits are always at acera.org/limits. Okay, so this is the whole thing put together. This is an example of us calculating a retirement allowance for a Tier 4 member who retires at age 65 after earning 25 years of service credit. So their age factor percentage based on their tier and their age at retirement is 2.30%. So they're going to get 2.30% of their salary for each year of service. And each year of service, in this case, in this example, is 25 years of service credit. And then their highest salary in this example was $6,000 per month. And so when we multiply these three things together, that gives us their monthly retirement allowance that they're going to get every month for the rest of their life, plus cost of living adjustments. Now, in this case, because they're getting 2.30% of their highest salary for each one of these years of service, if we multiply those two together, that tells us that they achieve 57.5% salary replacement from their Acera pension alone, which is pretty good. So if you remember from the beginning of the presentation, I talked about kind of trying to aim at 70 to 80% salary replacement total from all of your sources of income. And so if you could get 57.5% in this example from just your Acera pension, that's doing pretty darn good because you'll have other sources of income. And then that means that this $3,450 represents 57.5% of the $6,000 they were making before retirement. Okay, so that's general information about your future pension. Let me talk about how you specifically can get an estimate of your specific pension from your specific life situation. There are a couple of ways that I'll show you. One is a quick ballpark way of estimating your percent salary replacement that you're going to achieve. And so these charts are available out on our website in a couple of places. And so I'll switch the screen share over to the website. I'll just actually go ahead and show that to you. So here is Acera's homepage. And you can find those salary income replacement charts either under New to Acera or Planning Your Future Retirement Income. We'll look at the Planning Your Future Retirement Income page a little bit later, so I'll just go ahead and show it to you on the New to Acera page. Those are down here in these buttons. How much will your pension be in retirement? So what you do is you find your tier, and you go ahead and click on the button for your tier. So I'll click on Tier 4. And this gives you a chart where we have already calculated out we've already multiplied the years of service credit times the age factor percentage number to give you the salary income replacement number. So what you do is you think of a possible retirement scenario, like I'm going to retire at age 60 with 20 years of service, and you just make sure that you're on the right tier. And so you would go down to, let's see, 20 years of service, go over to age 60, and in that scenario you would achieve 36% income replacement. And this also gives you like a nice illustration of what happens if you continue working another few years, because each year that passes, if you work full-time, you'll go up 1 year in age and then 1 year in service credit. So just by working another year, you would go from 36 to 39.9% income replacement. Another year would give you 44%. Another year would give you 48.3%. And so you can just kind of look at the diagonal to see what an additional year of earning service credit and getting older would get you. Okay, let me check this question. Okay, the question is, if you're a safety tier 2 member and you reach your 20 years of service credit before age 50, can you retire and receive benefits before 50, or do you have to wait until 50 to receive benefits? As a safety member, you have this extra rule that says that if you achieve 20 years of service credit, you can retire at any age, even if it's before age 50. Because you're asking, I'll just go ahead and click on, let's see, if you happen to know exactly which tier 2 you're in, tier 2B, C, or D, you can write that in. I'll just show you the tier 2B chart for safety. And so in this case, like let's say that you achieved 20 years of service credit at age 48. Well, then you would have 54% income replacement. And so that's why there's all these numbers here that show you the income replacement before age 50, because you actually can retire before age 50 with 20 years of service credit. Okay. Let me switch back to the presentation. So that is your first way of kind of getting a quick ballpark estimate of what your future retirement allowance is based on just kind of the idea of income replacement. Now, the way to get a precision estimate is to log into your account on our website. So you go to our website, you click the login button, and you'll see this account summary screen first off, and this gives you all of that info about your particular membership with Acera. And you'll see that it tells you which tier you're in, your date of hire, your date of entry into Acera, how much service credit you've earned, how much you've contributed to the retirement system. So there's a lot of info in here. What you're going to do is click on Estimate a Benefit, and this takes you to the benefit estimator. And this is where you do a retirement estimate scenario. So you think, I'm going to retire 10 years in the future or 20 years in the future or whatever it is, and you put in a couple of dates in here that kind of fit that scenario. You don't have to know exactly what day you're going to retire, like 10 years from now, but you just kind of pick a date that makes sense. And the separation date is your last day of work, and your projected retirement date is your first day of retirement, which has to be at least the next day after your last day in active paid status. And so you would pick two dates based on that, and then you would hit calculate. Just to zoom in here to show you a few more of the screenshots, you would hit calculate, and then it will project an amount of service credit that you will have earned in the scenario that you are getting an estimate for. It will project how much of you, it will give you an estimate of your highest average monthly salary, also known as final average monthly salary. And using those two numbers and what it knows of your age at retirement, it's going to actually do a pension benefit estimate for you for this scenario. That service credit override field that I was talking about earlier, where you're using it to calculate service credit, whether a service credit purchase is worth it for you, that's this field right here. I don't recommend overriding the salary, and I don't recommend putting in hours of cash vacation compensation here. If you want to hear more about that, you could watch our pre-retirement seminar when I go through these screenshots in more detail. But for right now, I recommend leaving those blank. And you can put in beneficiary info here, and then you hit get estimate, and you end up with this pension benefit estimate, which is a PDF. And for the scenario that you're doing, and just to zoom in here, this information up here is kind of demographic info and data that it's using to calculate your estimate, which is down here. So don't get confused that this is not your estimate. This is your estimate down here. And there are different estimates that it gives you for each one of the different retirement options, which we won't delve into in this seminar. But for, I think, the purposes of new employees and mid-career employees, you can just look at this box right here, which is the unmodified option. It is the highest retirement allowance option that you can pick at retirement. And so I just tell people to go by this number. This is your retirement allowance estimate for this scenario with the red circle. Okay, so that brings us to an end of that topic about how to get a pension benefit estimate for you. Are there any questions on that? Okay, let's see, it's 10:30. Let me do this one more topic and then we can take a quick break because this one's short. So this is understanding retirement eligibility. Oh, here we go. Here's a question. Does our ACERA pension cover medical services after retirement? How many years of service are required and what percentage of the medical coverage? Great question. I will save that question for a little bit later. I have a slide on that. The quick answer is the ACERA pension doesn't cover medical, but there's an extra benefit that is a medical subsidy that you can get that starts at 10 years of ACERA service credit. But I have a slide on that a little bit later. Okay, so regarding retirement eligibility, we're talking about this milestone right here. So this is your first day that you're actually eligible to retire. So for tiers 1, 2, and 3, there's 3 ways that you can become eligible to retire. Option 1 is that you're age 50 and that you have at least 5 years of service credit, but you also have at least 10 years of membership with ACERA. So if you start working and you work straight through, what it really means is you're going to end up having 10 years of service credit with ACERA at a minimum. But not everybody does that. Some people will work the 5 years or 6 years or 7 years and stop working and then defer their retirement to a later date once they achieve this 10 years of membership requirement. So you have to have, at least 10 years has to pass from your first date of ACERA membership. So once you fulfill these 3 requirements, then you're eligible to retire under option 1. Now, option 2 is something I was talking about earlier regarding safety. If you have 20 years of ACERA service credit as a safety member or 30 years of service credit as a general member, you can retire at any age, even if it's younger than age 50. So that's option 2. Now, option 3 is you can retire with any amount of service credit, even if it's less than the 5 years here. You can retire with any amount of service credit at age 70 and above. So that's your third option. Now for tier 4, your first option for retirement eligibility is you have to be at least age 52 as a general member or 50 as a safety member, and you have to have at least 5 years of service credit. And you don't have to do the 10 years of membership thing. Just plain old 5 years of service credit, and you can retire. And then your second option is you can retire with less than 5 years of service credit at age 70. And that is how you become eligible to retire. Once you become eligible to retire, you can pick any retirement date that you want to. Okay, the next section that we're going to talk about is understanding additional benefits. And this goes to the question I had earlier that's still up on the Q&A board. The question was, does our ACERA pension cover medical services after retirement? And how many years of services required and what percentage of the medical coverage? So we will answer that right now. What I've been talking about thus far is mostly the benefit of your retirement allowance. Now there are other benefits. Medical, dental, vision, and other benefits are non-guaranteed benefits. So the retirement allowance is a vested benefit. These medical, dental, and vision are non-vested benefits, meaning non-guaranteed. There's also disability retirement. So that is an option if you ever become permanently disabled and can't perform your job duties. You can apply for disability retirement instead of having to wait for the regular service retirement. And there's also death benefits that are associated with different retirement options in different scenarios. So let's talk about the non-guaranteed benefits first to answer your question. These are extra benefits that are at some point in the past, the county decided that, I think it was maybe in the 80s, the county decided that the ACERA retirees needed these extra benefits in order to be able to pay for their lives in retirement. So they started this reserve fund called the Supplemental Retiree Benefits Reserve. and that reserve fund gets populated through various means when the retirement fund earns interest. And so there's this big reserve fund that pays for these extra benefits. There's almost $1 billion in there right now. And so our board of retirement, what they do is they determine what the benefits are that this fund is going to pay for, and what the levels of benefits are, and who qualifies for the benefits. Because the fund is just there for the benefit of ACERA retirees, and so the Board of Retirement has to figure out how to pay ACERA retirees in terms of these extra benefits. So the current non-guaranteed benefits are medical subsidies, and it's the medical subsidy is known as the monthly medical allowance, which is what MMA stands for, not mixed martial arts in this context. So the monthly medical allowance is a subsidy that helps you offset the cost of being enrolled in one of ACERA's medical plans. Because when you go to retire, we do offer you the ability to enroll in medical plans that we sponsor, and the subsidy helps offset the cost of those plans. There's also a dental subsidy and vision subsidy for offsetting the cost of dental care and vision care, Medicare subsidy, which helps offset the cost of being enrolled in Medicare, and a supplemental cost of living adjustment. So regarding what percentage of the medical services that the subsidy pays for, we don't really calculate it that way. The way the Board of Retirement does it is they set kind of a dollar amount of what the monthly medical allowance pays, and then it doesn't necessarily pay for 100%. In fact, it does not currently pay for 100% of the medical, and hasn't for many years. So you do end up owing part of the cost, paying part of the cost of the medical care. But if you achieve the full monthly medical allowance, then it pays for most of the cost. And I don't know the percentage off the top of my head. But the way it works here, and because this is a new employee / mid-career seminar, really we don't need to dive too deep into detail about what the plans are and how much they cost, because all that stuff is going to be different when you all go to retire. The plan costs tend to go up every year. Occasionally they go down. The subsidies change from year to year. What the plans are occasionally changes based on what we negotiate, so it might look different by the time you go to retire. The bottom line that I want you to know in this seminar is how many years of ACERA service credit it takes to start qualifying for these extra benefits, which is why I have this chart here. And so that's what this column is here. Now you see the supplemental cost of living adjustment, which is an extra cost of living adjustment in addition to the vested one. That doesn't require any years of ACERA service credit to qualify. But that's the only one of these benefits that is like that. The rest of them start at 10 years of ACERA service credit. And it's ACERA service credit, so any reciprocal service credit you have with other pension systems that you've linked together with ACERA, that doesn't count here. So it's 10 years of ACERA service credit starts getting you to qualify for the first level of the monthly medical allowance, which is half of the full amount, and then the dental subsidy, vision subsidy, and Medicare subsidy. Now currently the dental and vision do pay 100% of the monthly premium costs. That's why it says 100% here. And then if you get up to 15 years of ACERA service credit or 20 years of ACERA service credit, there's another couple of higher levels of the monthly medical allowance that you can get to. So the reason I want you to know this right now is kind of in terms of retirement planning. This is a good thing to know, because let's say that you've worked here for 9.5 years and you're starting to get restless and you're starting to look around for another job. You know, it might be worth it to just stick it out another 6 months, get over that 10 years of ACERA service credit mark, because the one half of the monthly medical allowance subsidy plus the dental and vision subsidy and Medicare subsidy is going to be a good chunk of money in retirement that will help you pay for the cost of your health care. So I think it's a good thing to aim for, which is why I like to think of it as an additional pension milestone, which is the healthcare subsidies milestone of 10 years. And so we can't really say whether the retirement eligibility is before or after this 10 years, but we'll just throw it up there like that. So that's how that works. So I hope that answers your question. Now, let me just go back a few slides here. Regarding disability retirement, I just want you to know that exists. I don't have any slides on that here, but if you ever do become permanently disabled and you can't perform your job duties, that you can apply for disability retirement. We have a whole section of our website on that. I do think I talk about death benefits a little bit later. Okay, so I think I actually talk about those right now. So this is about designating your beneficiaries, and keeping them current. Your beneficiary, that word just means somebody who gets benefits. Your ACERA beneficiary is the person you designate to get your ACERA death benefits. There are death benefits that are available to you should you die before retirement, and there are death benefits that are available to your beneficiaries should you die after retirement, which we're hoping is the case. But the death benefits after retirement we talk about in the pre-retirement seminar, but I'll tell you about the death benefits before retirement right now. So if you're not yet vested in ACERA and you die as an active member, your beneficiary will receive a return of your employee contributions plus the interest that we have posted to your account based on your contributions, because you're contributing to the retirement fund in your contribution account. We hold your contributions, and we post interest twice a year to that if the fund earns interest. So your beneficiary would get that money returned to them as your ACERA death benefit. Plus, they would also get 1 month of your salary for each year of service that you've already achieved, up to 6 months worth of salary. So if you've already worked for 4 years at ACERA, then they would get 4 months of your salary plus the return of employee contributions and interest. So that's if you haven't yet achieved 5 years of ACERA service credit. Now, if you have achieved 5 years of service credit and you're a vested member, your beneficiaries would have an expanded choice of options. They would still have that same option that I just described, which is called option 1. Option 2 is they would have the option of getting a monthly survivor's allowance, which they could get for the rest of their life. I think they do get it for the rest of their life if their spouse or state registered domestic partner, and that's why it says qualified beneficiary only. And in lieu of this, so they would just get that monthly survivor's allowance every month for the rest of their life. And it's sort of based on what your retirement allowance would have been based on the retirement that you've already earned up to the point of your death. It's sort of based on that. And then option 3 is a hybrid of options 1 and 2. So they would get a lump sum, which is 1 month of your salary for each year of service, plus they would get a reduced monthly survivor's allowance, less than option 2. Now, you can't designate which option they're going to get ahead of time. That's their choice whenever should this happen. If you're not an active member, we call you, and you're not a retired member, but you're still an ACERA member, we call you a deferred member. So you're not actively working and earning ACERA, your more ACERA retirement. You stopped working, but you haven't retired yet, and you haven't withdrawn your contributions to cancel your membership. You're still an ACERA member, so you're just kind of on hold. You're deferring your retirement to a later date. We call you a deferred member. And if you die as a deferred member, there's no extra death benefits. It's just a return of your employee contributions and interest. But that would always be refundable to your beneficiaries. So there's more on that at acera.org/death, which is our death benefits page. And one thing that I would like to say at this point is keep your beneficiary designations current, because we're going to pay out whoever you have designated on your ACERA beneficiary designation form. It doesn't matter what your will says. It doesn't matter who your beneficiaries are for anything else, for your county, death benefit, your life insurance payouts. That doesn't matter. It's whoever you've designated as your ACERA beneficiary. And so the way to check your beneficiary is you log into your account on our website. Go to our website, click the login button. See who it says is your beneficiary in there. If it says your beneficiary is your spouse from 3 spouses ago, you're going to want to redesignate your beneficiary. And you do that using our beneficiary designation form, which is available on our forms page. And you can get that, you download it, sign it. My recommendation is use the Adobe Scan app to on your smartphone to scan that in. And then inside Web Member Services, inside your account, there's actually a file uploader function where you can securely upload those types of forms that have that secure information. And as soon as you've uploaded it, your beneficiary is redesignated. So you could even do that today. Here is an example of the beneficiary page in your account on our website. So this is all the nominated beneficiaries that this fake person has. You'll see that this one is a primary beneficiary and these are alternate beneficiaries, and that is if your primary beneficiary dies before you do and you haven't redesignated your beneficiary, then it would fall to your alternate beneficiaries, or if they die at the same time that you do. Okay, so that's death benefits and designating your beneficiaries. Now let's revisit career planning. Okay, so we'll talk about career planning options, and then we'll talk about making a future financial retirement picture. So regarding career planning and regarding what your options are for leaving retirement with your ACERA covered position, you have a few options. Option number 1 is to retire. So when you quit your job, you just work straight into retirement and you retire. So that's always option number 1. Is if you're eligible to retire and you're done working here, you can just retire. Okay. Now you're going to earn service credit right up to your retirement. We will convert half of your sick leave into service credit up to a limit, and you'll get some additional service credit, and you can go work somewhere else if you want to. And we're just going to consider you retired, and we're going to pay you your lifetime retirement allowance for the rest of your life. And you can continue to get, like I just said. Okay, so that's option number 1. If you're eligible to retire and you're done working here, you can just go ahead and retire. Now, option number 2 is if you're going to quit working here, but you're not going to retire yet. So you're going to terminate your position before retirement. What are your options? So this is if let's say we add this additional pension milestone, which is that you are not working straight into retirement. You have a termination date before you retire. Okay. So I'm going to give you 3 options for if you stop working before you retire and don't go straight into retirement. We're going to call them A, B, and C. Okay. So option A is that you can become a deferred member. I mentioned this earlier. Becoming a deferred ACERA member means you stop working, but you don't retire yet. There's going to be some time period between when you stop working and you retire that we're going to consider you a deferred member. So you're not retiring immediately, you're deferring your retirement to a later date. That's why it's called deferred membership. And the only thing that you need to do to become a deferred member is not take a refund of your contributions. So you just simply leave your retirement contributions on deposit with ACERA, and you maintain your ACERA membership. Interest continues to accumulate. There's no negative interest. And what I mean by negative interest is that if the fund loses money in a particular interest period, we don't apply that to your account. It's only when the fund earns money that we apply that to your contribution account. So as a deferred member, your account balance is going to continue to grow. Okay. even though you're not actively contributing to it anymore. It's going to grow through interest. And then you can retire later out of deferred status. So you don't have to retire straight from active work. You can retire from deferred membership as well. Or if you decide later that you don't want to retire yet, you can come back to work and you become an active member again, and you start actively earning more retirement and actively paying into the system again. So you kind of pick right back up where you left off. Or if you don't want to retire from a SERA, but you just want a refund of your contributions, you can get a refund later, anytime during your deferred membership. So if at the time that you stop working, you're on the fence about whether you want to maintain your SERA membership or not, you don't have to decide right now. You can become a deferred member, and later you can get a refund of your contributions and interest at any time. And if we've paid additional interest to your account, then you're going to get to keep that additional interest. And then let's see. Okay, so that's the last bullet point there. Let me check this question. Okay, so this is regarding the death benefits. And the question is, when I talk about the beneficiary receiving contributions and interest, is it only the employee contributions, or is it the employee and the employer contributions? It's only the employee contributions. The employer contributions always stay with the fund. The only way that you get to take advantage of the employer contributions is by retiring from a SERA and collecting your monthly retirement allowance for the rest of your life. When you do that, what we do is we start paying you out of your employee contribution account. And then when that runs out in that first 3 to 5 years, then we start taking from the employer contributions. And when that runs out, then it's the interest that all of that money has earned that pays for your retirement allowance for the rest of your life. Okay. So this is option A, become a deferred member. Option B is to establish reciprocity. And establishing reciprocity is linking different public retirement systems together. So you're linking a SERA with one of the other many public pension systems in California. And so we have reciprocity with many of California's cities, California state jobs. It's not the UC system though. Any agency that uses CalPERS, which is the state's system. Some of the cities in California use CalPERS as their pension fund, And there's a full list at acera.org/reciprocity, which is a reciprocity page. The benefits of establishing reciprocity are that the service credit that you earn in all the systems combined is used for vesting and retirement eligibility. So you're not starting over earning service credit from scratch regarding becoming vested and becoming eligible to retire. So let's say that you worked for Contra Costa County for 5 years. Say you're a Tier 2 general member. You work for Contra Costa County for 5 years. You come over and work for a SERA for 5 years and link them together. You have 10 years of a service credit combined. And if you're over age 50, you can retire on that combined amount of service credit. The second benefit is that the highest salary that you earn under any of the reciprocal systems is used by all the systems. So for example, if you were earning $20 an hour over in Contra Costa County, you come over to SERA, you're earning $30 an hour. When you go to retire, we're both going to do a retirement calculation, but both of the systems are going to use your highest salary. So it's you're not starting over from scratch in terms of getting all of your highest salary used in all of the retirement formulas that are using to calculate your retirement. And then also, if you're in an earlier tier than Tier 4, it keeps your contribution rate lower. Now, in order to qualify for reciprocity, you got to do 4 things. One is that you become a deferred member. You leave all your contributions on deposit with the SERA. Number 2 is that no more than a 180-day gap can occur between when you stop working the first system and you enter the next system. So the entry date into the next system. 180 days is about 6 months. So if more than 6 months goes by and you don't get another job, then you can't establish reciprocity. And if you did get another public job, you would just start earning retirement over from scratch in that new system. You cannot have overlapping service. So you don't want to go on like a 12-week vacation to use up your vacation accruals at the end of your employment here and immediately start another job, because that prevents you from establishing reciprocity. Now, if that does happen, go ahead and contact Acera, because occasionally we can change some things around to like avoid the overlapping service problem, but it's most easiest if you just avoid it entirely. Then you have to retire from all the systems on the same day. Okay, so then let me check these questions. You said there's a cost associated combining. What do you mean there's a cost associated with combining? Are you talking about a cost associated with establishing reciprocity and linking the systems together? And the answer is no. There's no cost to that. It's just something that if you meet the 4 criteria, when you get into the next system, it's something that you request to have happen, that this reciprocity gets established, and then both of the systems will just do that for you. Okay, great. Yeah, there's no cost. That's totally free. And then let's see. There's another question. Members receive half of their sick leave balance towards service credit up to what maximum amount of time? I didn't answer that. The cap on that is based on your MOU, your Memorandum of Understanding for your position. And so that is something that you have to read in your MOU to see what the cap is for you. A lot of the caps are like 125 days of sick leave is convertible down to service credit. So that would be like 62.5 days of service credit. But that's how that works. We have more information on that in the pre-retirement seminar toward the beginning if you want to check that out. Okay, so we went over options A, deferring your membership, options B, establishing reciprocity. If you don't want to do that, you have option C, which is to take a refund of your employee contributions and interest. And so this means that you are saying, I don't want to be an Acera member anymore. I don't want to retire from Acera. I don't want to have a lifetime monthly retirement allowance. I don't want to have access to those extra non-guaranteed benefits or the death benefits or anything. Cancel my membership, give me my money back. So that's what terminating your Acera membership is, and taking a refund. So you can do it. When you do that, you may lose, if you take a lump sum payment, if that's what you're looking for, you're probably going to lose 1/3 of your money to taxes and penalties right off the top. If you roll over your money into a 457B account or another type of pre-tax account, then you would not be taxed or penalized at that point. So you would just roll over the full amount. Getting a refund can take a month and a half, 2 months. It can take more. It's not an instantaneous thing. Okay, and you're waiving your right to all Acera benefits. Now, let me just make a little pitch against doing this, because if you are already eligible to retire from Acera, or you're going to be eligible really soon, it's way more advantageous for you to go ahead and retire from Acera and collect that monthly retirement allowance rather than taking this refund. Because remember, I said in the beginning of the presentation, in the first 3 to 5 years of retirement, you're going to get all this money back anyway. And then you're going to get a lifetime payment after that. If you just take this lump sum refund, you're not going to get anything additional. And if you think you can go invest it somewhere and earn something comparable to what you would have earned from getting a lifetime pension payment from Acera, I'm skeptical of that idea. So if you've worked here long enough to be eligible to retire, then I think it's way more financially advantageous to you to retire from Acera and collect that lifetime retirement allowance than it is to do this refund. Okay, so let's see. I have a question. I worked for the Oakland Housing about 20 years ago for 6 months. Can I add that to my county retirement of 15 years? Will it bump up my retirement amount? So that is another public agency, so that would probably fall under the other public agency purchase. It was 20 years ago, so that's 20 years worth of interest that you would have to pay in addition to the employee and employer contribution amount that they would calculate from like 20 years ago. So the answer to your question, like the short answer is yes, it will bump up your retirement amount, but since it's 20 years ago, I'm not sure that you're gonna get a good return on your investment of purchasing that service credit. But the way to figure that out would be to go ahead and submit a service purchase request form to us, and we'll do the calculation and tell you how much it would cost. And then once you get that calculation, you can go back to the video of this presentation and you can see what I was telling you in the beginning about like doing the two estimates and seeing how long it's going to take to get that purchase money back. So then you can decide whether it's worth it to make that service credit purchase. But go ahead and fill out that purchase request form, because it can take a few months to get that info back about how much it's going to cost. Okay, so let's talk about making a retirement planning picture. Okay, so I'm just getting in this part I'm going to talk a little bit, and then I'm going to turn it over to Gene Hilliard from the county's 457B program to talk a little bit. So I was just promoting him to be a panelist. Okay, so we're revisiting this slide. This is the one I showed you in the beginning. So financial planners will tell you that in order to maintain your standard of living in retirement, you're going to need to be earning as retirement income 70 to 80% of what you were making before retirement. Now, when Gene gets on and starts talking, he's going to tell you he's going to try to get you up to 100%. Okay, so what we're both going to do is try to get you on that trajectory and get you pointed in that direction. Now, we've talked a lot about the ACERA monthly pension, which is going to be part of this equation. That's going to be part of your income in retirement. You're also going to be able to collect Social Security if you paid into Social Security for at least 10 full-time years. You will be eligible to collect that at a certain point in the future. And then everything in addition, everything beyond these two sources of income is going to be what you can personally save and perhaps invest in the intervening time between now and the time it comes for you to retire. So let's talk more about both of those things. Okay. What I suggest in order to get you on this trajectory pointed in the 70 to 80% income replacement direction is to first get some estimates. So you get out a piece of scratch paper and you do some estimates. You get on our ACERA's website and you use that benefit estimator and you do an estimate for a likely retirement scenario for you, where you're retiring at age 60 or 65 or 55 if you want to shoot for an early retirement. And then also go on Social Security's page and get a Social Security estimate for what they are planning on, what they will pay you when you become eligible to collect Social Security. So I'll just show you some screenshots of this. Again, this is the benefit estimator, okay? And so you would get the benefit estimate, and then you would take the benefit estimate number and perhaps even the salary number that it is using and your age at retirement, and then you just kind of write those on a scratch piece of paper. Okay, so in this scenario that you're doing, you're earning this pension amount from ACERA. That's about $2,300, and in this scenario, it's retiring at age 62. Okay. Now then you go out to Social Security's website and use their estimator, which is ssa.gov/estimator. It's going to look kind of like this when you complete the estimator. So you actually log in as yourself into their system, and it will use your data that they have for you to calculate this estimate. And what they'll usually do is they'll give you 3 different ages at which you can collect a monthly Social Security amount. There's the earliest age, which is 62, and so it's about $1,700. And then they'll give you a couple more ages like age 70 and age 67. But between 62 and those older ages, you can retire and earn more and more and more from Social Security. I think in this screenshot it's saying the full retirement is at age 67, which you would kind of I'm not sure why there's an age 71 that has more. Okay, so then you bring those back and you write those down in your scratch piece of paper. So we're going to stick with this age 62 example. So you're making like $2,300 a month from Acera and about $1,700 a month from Social Security. What I recommend is then doing a series of retirement calculators. There's a whole bunch of links on our website, on our retirement planning page. One of them is the Prudential Retirement Calculator, which Gene is going to show you, which will help you do these calculations. If you have a 457B account, you can log into your account there and use their calculator. I'll show you the Vanguard calculator, which looks like this. And I'll just take a few minutes and kind of show you how I think about this. And when I turn it over to Gene, he'll show you how he thinks about it in a slightly different way. So the way to get to these calculators is to go to our website, go down to Preparing to Retire. And I'm sorry, scratch that. You go to Planning Your Future Retirement Income. Preparing to Retire is when you're getting ready to retire. Planning your future retirement income is, planning for the future. This whole page, I recommend going through this page step by step. This is sort of the more detailed version of the short version that I'm giving you in this webinar. And so you can kind of do this at your own pace. So, it takes you through all of these steps. So here's the link out to the Vanguard calculator, and here's the different calculators you can try. I recommend trying a few because they'll all give you kind of a different number. The number that our goal here is to determine how much additional to save beyond, so that, because we're going to have our Acera income, we're going to have our Social Security income, and we want to know if there's a gap that gets us up to that 70 or 80% mark. And so the Vanguard calculator kind of is a way to kind of figure that trajectory out. So in this scenario, we're going to retire at age 62, and let's say that I'm 25 years old, and let's say that I make $65,000. Let's say that I don't save anything currently. We'll just keep it at 0 for now. So if you do have savings, you can put it in here. Let's say you haven't saved anything, but let's say you have $10,000 in the bank, you can put that in here, or $10,000 in your 457B plan, you can put that in here. And let's say that you have, you already have an amount that you save every month, you could put that in here if you want. We'll leave it blank for right now. Okay, so this space right here is where you're putting in how much income replacement you want. So we were saying between 70 and 80%, so let's just say 75% and see what happens. Okay, so this number right here, the annual return that you can expect from your retirement savings, this is going to be individual to you. If you're not familiar with investing, or if you are familiar with investing, if you're not familiar with investing, maybe you're not familiar with the risk versus reward of investing. Generally, the riskier places that you put your money, the more potential to earn a higher percentage rate on your money, comes with more risk. So it's when you take a little bit of a dive into this, you'll kind of get an idea of where your comfort level is with that. I think this number should be somewhere between, just for our purposes here, somewhere between 2 and 7%. And 7% is even it's even kind of on the conservative side. That's what Acera expects to make every year in our investments is 7%. And we have a huge fund that's professionally invested, but we still do kind of take a conservative approach. So 2% is a percentage that you can get from putting your money in very safe places. So it's kind of like a minimum. So let's say 6%. Okay, I'm going to hit calculate here and see what happens. Oh, no, sorry, I need to go back. I need to add additional income sources. So in this scenario, we know that we're receiving a $2,300 monthly pension, and the Social Security estimate was $1,700. Okay, so I'm going to recalculate this. Okay, so this worked out well. The goal is to get these even, and it's saying that I don't really need to save any additional money, because in this scenario, starting at 25 years old and going up to age 62, between my Acera pension and Social Security, I'm going to get up to 75% income replacement. Okay, now maybe this scenario isn't like your scenario. So let's change the ages here. I'm going to go between 35 years old and age 62 and see what happens. Oh my gosh, I'm so sorry. I forgot to change the share. Here we go. Sorry about that. I was still on the screenshot. So sorry. Okay, so now you can see what I'm typing in to the still screenshot. Okay, I'm not sure why this is. Let me reload this and see what happens. They recently changed this, and it used to be a lot better. And now it doesn't work as well. Okay, so let's calculate. Okay, now it's showing a gap. And so the goal is to get these two graphs even. Okay, now what I'm going to come up and do is put in some retirement savings. So I'm going to save $1,000 annually. And then I'll recalculate it and see if I can get those even. Nope, not quite. This used to have sliders, and you could just change the slider and get it right even. So that's a little, I overshot it. Okay, so now they're about even. So what I was doing here is I put in my retirement scenario, and I was changing the amount that it's telling me that I need to save annually until what I'm doing is achieving 80% income replacement here. Okay, and so you just keep playing with the numbers until you get to a point where these graphs are kind of even, and then you look at this number and it's telling you need to save $2,000 a year. Okay, so $2,000 a year divided by 26 pay periods is about $76. So that is not that hard to do to get, and that gets you pointed at this 85% income replacement. So that's just kind of a simplistic example of how these retirement calculators work. The bottom line is what you're trying to do is figure out that number, that additional number that you need to start saving now to get pointed in the 70 to 80% direction. So what you do is you do the calculator, and then you change your amount that you're saving every pay period, and you kind of get pointed in a direction. And then maybe you come back a year later or 6 months later and you redo the calculator. And maybe you find that you're kind of off. You're not quite pointed at 70 to 80%. So you adjust your savings so that you get repointed at that percent income replacement that you're looking for. And then you come back a year later, and maybe it's a little off again, so then you readjust it. Okay, And so if you just do this periodically, you don't have to save, you don't have to like save an astronomical amount right this minute. You just save what you can, and then periodically you come back and you make little adjustments, and you just kind of save more and more to get pointed in that 70 to 80% trajectory. And then over time you'll find that once you get there, you've achieved 70 to 80% income replacement. So that's my little spiel about how to do that. Now regarding where you are going to want to save your money, you're going to want to save your money somewhere. If you're okay with this, my recommendation is to save it somewhere where your money can earn interest, even if it's just a high interest savings account. Because what interest does is it helps you beat inflation, which is around 3% per year, and it helps you earn more through the power of compound interest. Because in compound interest, you're earning a little bit of money based on the money that you are saving, and then that money that you earned, you're earning more money on top of that additional money. And then that additional money combined, you're earning more money on top of that as time goes by. And so that's why a compound interest graph is curved, because the power of compound interest accelerates your interest over time. And I'm kind of hurrying through this because I need to turn it over to Gene really soon. I mentioned this before, the higher the potential interest, the higher the financial risk. So your caution is what you should navigate by, not necessarily any advice anyone's giving you. And then regarding where specifically to save your money, where you can earn some interest, there are these type of combined defined contribution accounts where you can that are like invested in various investment vehicles that will help you earn interest. And one of those, the main one that we're going to focus on, is the 457B plan, because that is the type of account that government employees can save additional money on a tax-deferred basis from directly from their paychecks. There are some other lower risk savings options. Say that you're a really good saver and you max out your 457B account and you're looking for some other low risk options. Those are kind of listed out here. Those are also listed out on that retirement planning page, which I'll go back over and just kind of show you that planning for retirement page. So there's a lot more detail about this that you can dig into on this page. It's step 5. So it talks about the 457B plan, and it goes into detail about each one of these other types of things like high interest checking and savings accounts and money market accounts. I'll let you peruse that information on your own because we're kind of running out of time. But that's a good resource is that retirement planning page on our website. And then going back to the presentation, one thing that I do want to point out is that it's good to do your own research about these different places that you might want to put your money. There are a lot of websites out there. One of them is NerdWallet that will list out all of the current deals on high yield checking accounts currently, for example. Or Investopedia. They'll explain different investment concepts really simply for you, and they'll just kind of get you pointed in the direction of where you might want to park your money. So I recommend doing a lot of your own research, and then just remember that you're solely responsible for any investment risk you take on. So it's good to do your own research. You can get more help, and because you are not a investment professional, I'm assuming, and so there are financial planners from the Deferred Compensation Program, and Gene will tell you all about this. And you get and they're free once you sign up for the program, and they'll work with you and get you started on this trajectory of the income replacement that you need to retire. And one thing that I want to point out is that you can also hire financial planners, but you should always look very closely at their fees. If you're going to get one of those financial planners that wants to charge you an annual percentage of your account balance, even if it's 1%, that's a huge fee, because that's really going to cut into your ability to earn compound interest. So be very careful about hiring financial planners. And then again, that expanded article that I just kind of went through on a summary basis is at acera.org/planning. Okay, the last thing I'll say about Acera before I turn it over to Gene is that if you want to keep track of the important stuff that goes on at Acera, and you don't want to just continually check our news page, you can subscribe to email news at acera.org/subscribe. For active members, there's never news. I mean, there's hardly ever news. Maybe once a year, maybe once every couple of years. So it's not like we're going to be sending you news all the time. It's like only when something important happens. So I recommend doing that. Okay, our final bullet point is starting a 457B account. And I'm going to turn it over to Gene Hilliard at this point, who is the representative from the county's 457B program, and he's a financial professional. And so let's go ahead and get Gene going here.
Right. Can you guys hear me okay? I'm getting my video going.
Okay, yep, we can hear you.
All right. So let's see.
I'm going to go ahead and stop my share so that you can.
Okay. Perfect. Let's see. All right, perfect. Can you guys see the screen okay?
Yep, we can see it. We can hear you. Just
Okay.
as a kind of a time check, I kind of went 15 minutes into your time. Sorry about that.
Okay. Oh, no
But
worries. No worries.
one thing that we could do is, because this was scheduled to end at noon, but how about we'll just like, if you need to, just go to 12:15, and if any of you who are participating can't hang around that long, you can feel free to leave, and we'll go ahead and post this up on our website within the next week, and you can come back in and see the part that you missed.
Okay, perfect. All right, let's go ahead and get started again. My name is Gene Hilliard. I'm Vice President and Financial Advisor of Emerge Financial Group. I was hired roughly 11 years ago by the county and by Prudential to provide retirement planning, investment advice, and education to county employees. I have been working in the investment industry for roughly 18 years as a stockbroker, helping each and every one of my clients create wealth and maintain their wealth at the same time. And I'm also a certified retirement counselor. And my goal as a certified retirement counselor is to help each and every one of you maintain your current lifestyle in retirement. And what I mean by that is to hopefully get you working towards a trajectory where you're going to get 100% of your salary. Let's give it a shot. And if we have to settle for 70 or have to settle for 80, that's fine. Okay, so let's go ahead and get started. Part of the presentation is, what is deferred comp? What are the benefits? How do you manage the money? And then lastly, how do you spend this money in retirement? For those folks who are currently in the plan, that is wonderful. That is outstanding. But hopefully I can convince you to put even more into deferred comp. So let's go ahead and get started here. All right, why save in the deferred compensation program? Well, I'm sure you're probably already aware. Best case scenario, you're looking at receiving 50% of your salary. And if you are like me, living off of 50% of your salary in retirement will be a challenge. Now, maybe some of you are thinking, well, I'm going to move to Costa Rica when I retire, so the cost of living is much lower. Maybe I can make 50% work. But many of you, it's probably going to be a challenge. And you want to use deferred compensation to help you plug that hole, to help you increase that income replacement from 50 to 80 to 90 to possibly to 100. Okay. Another big reason why you want to save more towards retirement is inflation. Stop and ask yourself, okay, how much was a gallon of gas when I was young versus a gallon of gas now? I kind of remember when I was growing up, my parents paid 70, 80 cents a gallon. and we're looking at roughly $4 a gallon right now. Think about your PG&E. Think about your water and garbage. So inflation will take a bite out of your retirement savings. So it's important to put even more away to keep up with inflation. And then what about healthcare prices? I know when I first started working with county employees, I kept hearing, hey, if I can do 20 years with the county, my healthcare will be paid for the rest of my life. And since you sat through this presentation, you're probably well aware that's not necessarily the case. You get a stipend towards your healthcare, but it doesn't necessarily pay for your entire healthcare for the rest of your life. So healthcare prices tend to increase over time as you age, especially if you're retiring between the age of 62 and 65. Once you hit Medicare age at 65, then from what I understand, healthcare prices seem to stabilize a little bit. Okay. It's simple to invest and save in deferred comp. There's a couple of options. You can save in a tax deferred manner, right? Minimum of $20 a year, all the way up to $19,500 if you're under 50. If you're 50 and over, you can invest $26,000 a year. This is pre-tax. So the way that works is if you put money in the deferred compensation plan pre-tax, it reduces your taxable income. So let's say hypothetically you make $50,000 a year working with the county and you decide you want to put $5,000 into deferred comp pre-tax. Well, you're going to be taxed on $45,000 versus being taxed on $50,000. So you save in taxes. But the tax deferred option really works best if you believe you're going to be in a lower tax bracket when you retire, right? You're working right now, you're in a 28% tax bracket, so you're deferring. You're going to wait until you retire when you hope you're maybe in a 15% tax bracket. Okay, so again, it makes sense if you believe you're going to be in a lower tax bracket when you retire. But there's some of you probably on this call that believe, as a country, we're running up debt as far as the eye can see. Seems like whether or not you're a Republican, Democrat, don't worry, we're not going to get into politics, but it appears that the national debt continues to get high, to go higher and higher and higher. And at some point, there's going to be a day of reckoning and taxes are going to be raised on everyone. So, Gene, I would rather get the taxes out of the way right now. So the Roth version of deferred comp may make sense to you. Pay the taxes now, avoid having to pay the taxes in the future. Okay. You can increase, you can decrease at any time. Let's say, it's November, you have to spend a ton of money on holiday gifts and you want to stop or decrease the amount of money that's going in deferred comp. You can do that. Or it's summertime and the kids are going through their summer events that you have to pay for. And it's going to cost you an arm and a leg, but you can decrease the amount of money that's going into deferred comp. You get personalized service support from 3 financial advisors with the plan at no cost to you. So there's myself. My firm is Emerge Financial Group. Log on the website, schedule a one-on-one appointment. I have a colleague, Mark Tomei, who can help you with Wells Fargo advisors. And then lastly, there's Jason Brummett with Prudential, who can help you with retirement planning. There are 12 investments available in the plan, all the way from your most conservative investment, which is the Alameda County Stable Value Fund. So if you're not interested in taking on any risk, you don't ever want to see your account go down in value, the Alameda County Stable Value Fund may be for you, right? If you're the type of person that appreciates Vanguard funds or index funds, there's a fund family in the plan called State Street that offer index funds that are very inexpensive. That fund or funds are available to you. If you're the type of person that is interested in investing in socially responsible funds, no alcohol, tobacco, firearms, there's a mutual fund in deferred comp called the PAX mutual fund that you can invest in that's considered socially responsible. Okay, so you can choose your own funds. You can create your own portfolio. But if you're the type of person that's an expert at what you do and you need some help creating a portfolio, there is a program called Goal Maker that you can invest in. It's an award-winning program created by Prudential Retirement and Morningstar, where you tell us what your investor profile is. I'm conservative, I'm moderate, I'm aggressive. You tell us when you anticipate retiring, and then the system will create a diversified portfolio on behalf of you and your family based upon your when you plan on retiring, and your risk tolerance. And one of the biggest benefits of deferred comp, unlike a 401k, 403b, you have penalty-free access to your money at any age without a penalty. You can access your money without a penalty, provided that you've separated from service. 403b, 401k, you access your money prior to 60, you're not only are you taxed, but you're penalized 10%. Here, with deferred comp under tax code 457B, there is never a penalty. Okay, contributions are automatically deducted from your paycheck, right? Very, very easy. Some people find it very difficult to save. If you get paid, you pay all your bills, and if there's money left over, you're going to put it in an investment account. If you have kids, you live in the Bay Area, 9 times out of 10, it's very rarely that you have money left over, right? So we take the money from you before you pay your bills, and it's invested. So when you don't see it, you don't miss it. And then lastly, you don't spend it on that large latte Starbucks coffee or latte at Pete's. Okay. No playing catch up. This slide really illustrates why it's important to start sooner rather than later in terms of investing in deferred comp. Here's an example of a person who's 25 years old. They're investing $300 a month. They plan on retiring at age 65. You're looking at roughly $575,000. And that's assuming a 6% rate of return, which is reasonable. Well, let's say, you didn't get the religion. You heard my presentation 10 years ago. Hey, you started a family, you bought a house, you just couldn't afford to invest in deferred comp. So you decided, all right, I'm 35, I'm going to start now. But because you waited, it's going to cost you a little bit more. So this person is investing $500 a month, right? For the next 30 years, they still plan on retiring at age 65. They have roughly $490,000. And then lastly, here's an example of a person who's 45. They had to up the ante as well, $1,000 a month for 20 years. You're looking at $455,000. Okay. Now, the whole point of this illustration is if you start sooner, it'll cost you less. You can build up a significant nest egg by age 65. If you started at 25, $575,000. But at the same time, if you started late, all is not lost. You can make up for lost time. So starting earlier, even if you started late, it's okay. Bottom line, it's important that you start saving as soon as you can. How much do I need to save? I tend to tell people who are years away from retirement, it's very difficult to know exactly how much you should save. But I tell people shoot for 10% of your salary. So just take your gross salary, multiply that times 10%, divide by 26 pay periods, and that's roughly how much you should save towards retirement. But in many cases, it's these are questions that you probably want to ask yourself. At what age would you like to retire? Is it age 65? Is it age 60? Or is it age 55? That will kind of dictate how much you need to save towards retirement. How many dependents will you have? Where do you want to retire? What type of lifestyle do you want to live? Okay, those are questions you want to ask yourself. Retirement age, typically with the county, from what I understand, the normal county retirement age is 57 and a half. But I would say by and large, people wait until their Social Security full retirement age, which is age 67. And that's where you'll get a significant amount of money from Social Security. But at the end of the day, age really shouldn't be a factor in terms of saving towards retirement. It's really about how much you have saved, how much you have in the bank. If your bills are low and you've saved up a significant amount of savings, if you can pay your bills with your savings, then you can retire, right? Then dependents, most people will assume, hey, I don't have any dependents. My kids are grown and they're out of the house, but you don't stop to think that maybe your parents may need your help at some point and may need to move in with you, or maybe you have a special needs child. So that's going to affect how much you should save towards retirement. Where do you want to live? Obviously, on the East Coast, West Coast is going to be pretty expensive. You could move to Middle America, where the cost of living is much lower. But I will say, from my conversations with retirees, folks that retire tend to want to be near their grandchildren. And if your kids are on the East Coast or on the West Coast, 9 times out of 10, you're probably going to be on the East Coast or West Coast. So you might want to save, assuming you're going to be living in a high cost area of the country. And then you have your lifestyle. Do you want a modest lifestyle, moderate, comfortable, luxury? Do you want to be able to, maybe you're the type of person that says, I've spent my time breaking my neck working for the county, taking care of my children. I want to live it up and not have to worry about money. But it's important that you make that decision sooner rather than later, so you can save the amount of money that's going to be needed to support that lifestyle. How do I save? There are a number of different ways that you can save towards retirement. There's IRAs, where you can contribute 2021. If you're under 50, you can contribute $6,000 a year. If you're 50 and over, you can put away $7,000 a year. But if you can afford it, why not take full advantage of what's available to you in the 457B plan with Prudential, where you can put away $19,500 a year or $26,000 a year. Okay. Pre-tax contributions, in a nutshell, if you invest $1, if you get paid $1 and you invest that dollar pre-tax, the 100% of that money is going to go into the plan and grow over time. But if you decide you want to invest either in the Roth, or you just want to invest in a brokerage account at the credit union or your local brokerage firm, you get paid $1. You're probably going to have to pony up 25 cents in terms of taxes, and then only 75 cents of that dollar will be invested. Okay, so it's your choice. I'd rather get that entire dollar working for me over time for the next 30 years or 20 years or whatever the case may be. Contributions, the way that contributions to the Roth, the way that works, let's say hypothetically over your career, you invested $100,000 in the Roth. It grew to $500,000. That means you have a built-in gain of $400,000 that's tax-free to you. And I'm sure some folks on the call are thinking to themselves, how in the world would the IRS or the US government allow me the opportunity to pocket $400,000 without having to pay taxes? There's got to be a catch. Well, there is a catch. The account has to be open for at least 5 years, and you have to be at least 59 and a half, and then that money is tax-free to you. So the Roth version of deferred comp really makes the most sense if you believe and I mentioned this earlier, if you believe you're going to be in a higher tax bracket. You want to go ahead and pay the taxes now and then avoid having to pay a higher rate down the line. If you're unsure in terms of which option you should go with, whether it be pre-tax or the Roth, I would strongly encourage you, check with your attorney. Check with your CPA or the person that does your taxes, and get their opinion. come visit with me if you'd like. Schedule an appointment. I can have a conversation with you regarding your tax situation. I'm not a tax person, but I can give you some guidance in terms of which option may make sense for you. Okay. Now, there may be some of you that are on the call that are not in the plan and you're reluctant to invest in the plan because you're concerned about your money being locked up. Well, I'd say roughly 5 or 6 years ago, they changed it where you can take a loan out against deferred comp, right? The way the loan works is you can take 50% or $50,000, whichever is less, to be used for whatever you want. There's no credit check. You just complete a form. There's two types of loans. There's the general purpose loan. That type of loan, you have up to 5 years to pay it back. You can use the money for anything. And then there's also the primary residence loan, where you can take out the same 50%, $50,000, but you can use that to purchase your the home that you're going to be living in, and you have a maximum of 15 years to pay that back. So obviously, the further out you amortize that, if you were to go the full 15 years, then that payment is going to be much, much smaller. There were a slew of participants who took advantage of the loan feature back during the last Great Recession, where folks were unfortunately being foreclosed on, and you can buy a home for 50 cents on the dollar. People were borrowing against deferred comp to purchase homes. Okay. Or so let's say hypothetically, you got student loan debt you want to pay down. You can use deferred comp. You get in a little trouble with credit cards. You can use deferred comp to pay that down. You want to pay off Johnny's student loan, or you want to use the money to pay for Johnny to go to college. You can borrow against deferred comp to make that happen. To learn more about the loan feature, just schedule an appointment with me, and then we can kind of take it from there. Okay. What's next? I would encourage everyone to log on to prudential.com/retire-wow, click on enroll, and then start the enrollment process. Once you've clicked on enroll, you'll need your employee ID number, your name, birth date, email, and then we will send you a link to start the online process. Okay. For those folks who are currently in the plan and maybe you want to increase it, go to this same website and then scroll down and it says increase your contributions. Just click on that link and then follow the prompts to increase the amount of money that's going into deferred comp. Okay. Same website, there is a retirement income calculator that you can use. It's a great tool. It will tell you if you're on the right track and trajectory to retire at 80% or 70% or whatever the number is. You'll just need to enter in how much you're receiving from Social Security, and you'll need to enter how much you're receiving from ACERA, and then we'll tell you if there's a gap, if you should work longer or if you should save more. Okay, there are 3 financial advisors that you can visit with me or visit with. There's Mark Tomei on the far left with Wells Fargo Advisors, myself in the middle, and then you have Prudential Retirement Counselor Jason Brummett. So just dial this number 855-969-4572, hit option 1. No, I'm sorry, hit option 3. And then you can schedule an appointment with Mark or myself, or you can hit option 4 to schedule an appointment with Jason. Okay. And there's the website again. Now let's fast forward the clock. Let's say you've retired from the county, you have $500,000 or even $1 million. How can you spend that money? Once you leave county service, you can spend the money any way you wish. Most people look at it like this. Gene, my bills are $5,000. I'm getting $2,500 from ACERA. I'm getting $2,000 from Social Security. I'm short $500. Okay, send me $500 out of my deferred comp account monthly until the account's exhausted. You can do that. Or you could just ask for money when you need it. Some folks are saving in deferred comp to do the special things in retirement, such as vacation or buying a car. They use deferred comp for that. So you can just call Prudential and have them send you a check. Keep in mind that Prudential will automatically withhold 20% federal and 3% state on any disbursement. So just kind of keep that in mind. Okay. Once you leave county service, you can leave the money in the plan. No harm, no foul. You can still visit with Mark, myself, or Jason to help you manage the money. You can roll that money to an IRA. Maybe you're the type of person that prefers to invest in stocks and you have an interest in stocks. You could move your money to an IRA and invest in stocks. Or maybe you're the type of person that wants to buy real estate with your assets in retirement. That is an option. Just come visit with me so we can work through the details before you do it. Okay, so with that, that is the conclusion of my presentation. Any questions that maybe I can answer? The burning question.
Feel free to type your questions into the Q&A feature.
All right. While people are thinking, I can think of a couple of questions that typically come up. Number one, people ask me all the time. I have a 457, 403B at a different employer. Can I roll that money in? And the answer is yes, you can do that. There's a couple of forms you'll need to complete. A rollover to Prudential form. You'll need to include a copy of your most recent statement and send that in to us. You'll need to contact your former employer to find out if they require any paperwork. And everything will happen behind the scene. There's no taxes on that type of transaction, provided that you do it correctly. If you complete the forms, they'll send a check directly to Prudential for your benefit and deposit that money directly into your deferred comp account. The other thing that comes up is at age 72, you're required by law to take out roughly 4% of your salary. So just keep that in mind. If you don't take out that minimum required distribution, there's a 50% excise penalty. So I would strongly encourage you to make sure you get that money out of there. You turn 72, but this is a mid-career, so I doubt if we have folks that are close to that age on this line, so that may or may not apply.
Yeah. Well, we'll go ahead and end the recorded portion there. I mean, we'll hang out for as long as the rest of you would like and answer any additional questions. But I would just like to say to you all and to everyone who's watching this later, thank you so much for spending your time with us and learning about your retirement. And we wish you a beautiful career and a beautiful retirement and a beautiful life. Thank you.